Hey guys, what's up? It's Viral from Trace Trades, and I'm here with the first part in our fundamental analysis basics seminar. So the way I'm going to do this is basically, because there's a lot of information that we're going to have to cover, I'm going to divide this into about 4 or 5 different seminars. This one's just going to be a broader overview of what it means to fundamentally analyze stocks, and the rest of them are going to go more in depth with the nitty-gritty on, how to actually analyze these stocks. So I'm just going to get right into it. Before we start, it's important to understand a few things. So first of all, the principles of fundamental analysis are really only as good as your personal ability, and that is, your business sense, the assumptions that you use when performing fundamental analysis, and your own analysis itself are all going to be contingent when it comes to how successful you actually are with your analysis. So a common phrase that a lot of investment bankers like to use is garbage in, garbage out. And that definitely applies with fundamental analysis when picking stocks to invest in. Also, everyone has a different investment philosophy, so that means that everyone is going to have a slightly different opinion on what it means to have a good investment. So a good example of that would be value versus growth investors. Very different philosophies there. We'll discuss more on that later, but just know that one person's definition of a good investment is going to vary from another person's. Also, the information provided in this presentation, I'm simply providing you guys the tools that will allow you to make informed analysis on your own. The rest is going to really be up to you and your own ability to apply these tools. And last thing, this presentation and all subsequent presentations are going to be made by someone, that someone being me, with his own personal investment philosophy. So a lot of what I say might be slightly biased towards what I believe is, the correct way to do things. And that's not going to impact the actual information, but maybe the delivery might be slightly biased, so just keep that in mind as you consume this information. So before we start actually talking about what fundamental analysis is, it's important to understand what long-term investing is and why we should be investing long-term. So if you guys are a member of Trace Trades, you should know that we are primarily an options trading group chat, so we trade options in the short term, and it's great. You can build up a lot of capital very quickly doing so, but the short-term trading shouldn't be where all of your money is if you're investing in the stock market. In fact, most of it should be in long-term equity, and there's several reasons for this. First of all, market conditions are subject to change at random, which means that a lot of shorter-term strategies are going to be made obsolete when these market conditions change. So if you guys have been paying attention to the market recently, you should know that there's been a lot of chop, and that has screwed up a lot of otherwise very solid setups, just based off of the volatility and the randomness, uncertainty in the market. So that's a good example of a time where certain strategies might not work in one market, but they would work in another market. The second reason is that options and futures, aka derivatives, these are the main tools that short-term traders employ, and they're risky, really risky by nature. So if they're used incorrectly, you can really lose a lot of money in very short periods of time. I've seen it happen time and time again. People who come through our service, and even just people like on Wall Street Bets, who are people who use other similar services, they don't practice proper risk management, or they just don't understand what these assets are that they're trading, and they'll just lose money. They'll lose all their money very quickly. Third of all, when you try and time the movements of the market, you incur on opportunity costs. That is, there is always the chance you're going to miss large movements in the market, or you could sell early, sell late, enter late, etc. A lot of the movements in the stock market, a lot of the major movements in the stock market happen in very short periods of time. So you don't want to run the risk of missing those movements because you're trying to time the market. So when you invest in something long term, there's no chance that you're going to miss any of these moves. And also with short-term trading, it's really just generally more stressful, especially if you're trading options which have an expiration date. You guys should all know, if you're trading options, that options are depreciating assets. Eventually they're all going to go to zero. They're all going to be worthless. So keeping that in mind, trading these sorts of things and trading with a shorter term time frame, there's more pressure for you to make a profit. And also, if you guys have heard of the Buffett bet, basically Warren Buffett, arguably one of the greatest investors of all time, made a bet with a hedge fund that they wouldn't be able to outperform the S&P in the long term, and he won that bet. So it's pretty well known throughout the investing industry that most actively managed funds won't outperform the S&P in the long term. And by long term, I'm talking decades here, right? And that's not to say you shouldn't try. In fact, I'm a total advocate of you trying to beat the market, especially if you're on the younger side. You have the time. You have the luxury of time to be able to take increased risk. But ultimately, you want to be more or less focusing your efforts on longer term growth and investments that will appreciate over time, as opposed to more riskier strategies. So why invest in the long term then? So when you invest in the long term, the primary reason for doing so is we take advantage of a very powerful yet simple means of building wealth, and that is compound interest. So the average return of the S&P, aka SPY, is 10%, which means if I put $1,000 into SPY, in 1 year, I can expect a $100 return. It's 10% of 1,000 is 100, right? However, in the next year, assuming I hold my investment and SPY appreciates another 10% in the year, I can expect $110 of return, because 10% of $1,100 is 110. So what this means is our returns increase exponentially the longer we're in the market. Since we're holding good investments when we invest long term, that we would expect these investments to appreciate over time in the long run. We can catch all of the movements in their stock prices in their entirety without the stress of timing the market. And there's also no expiration date on stocks, so you can hold stocks forever, as opposed to options. When they hit expiration, you either have to roll them or just cut them or let them expire and expire worthless. From a long-term perspective, and that's years, decades, whatnot, stocks will trade based on a company's long-term performance, or at least what the market thinks of it. And they're not going to trade based on technicals, and technicals would be price action, volume, order flow, supply and demand, whatnot. And I should note that the majority of our team here at Trace Trades, we're invested primarily in long-term equities. All of the option trading that we do is quote-unquote play money, so that's about maybe 10% of 15% of our capital that's invested in the market. So that's just an important tidbit to note when considering the amount of risk tolerance we have for options, as well as why what we're doing with most of our money and why we're doing it. So what exactly is fundamental analysis? So fundamental analysis, also known as FA if you want to use abbreviations, it's the process of identifying companies that are worth investing in the long term, based on their business model, financials, brand, management team, etc. When you perform fundamental analysis, you're looking at a company's prospect over many years into the future. And it doesn't involve the study of stock charts, volume, price action. This is all technical analysis. I like to say that fundamental analysis gives you an idea of why, and technical analysis gives you an idea of when. And despite being vastly different in terms of the analysis that you perform, both forms of analysis are based on one underlying principle, and that is risk versus reward. So here's a little side-by-side comparison with fundamental analysis. You're gauging the true value or growth potential of stocks, whereas in technical analysis, it's more about supply and demand and present sentiment, right? And obviously fundamental analysis is more longer term, technical is more shorter term, and I've already sort of discussed what we're looking at with each analysis methodology, so I won't go repeat myself, but yeah. The considerations when performing fundamental analysis, and these are things that we'll all go over more in depth in future seminars, but basically, we got to consider what industry the stock resides in, and what the long-term prospects are for this industry. And a good example of that would be Tesla in the EV space. Automobiles. Everyone has a car. Everyone needs a car to go places, and we all know that how harmful oil and gasoline are for the environment. So the EV space in general has potential to be very disruptive and have a lot of growth. If we think about how many cars are in the United States alone, and if we turn all of those electric, that's a lot of sales, right? So that's one thing we got to consider. Another thing we got to consider is the company growing? Is it stagnant? Is it declining? And also, what sorts of risk is the company exposed to? Like, if XYZ variable changed in the industry, or like the economy, or just consumer preferences change or something like that, how likely is that to significantly impact company operations and profitability, right? Also, we got to consider what the story is behind this stock, what's going on in the broad market, in the economy, why are people currently invested in the stock right now, what other factors are important to this company. For example, like Netflix, a company like Netflix is very based on subscribers. Subscriber count, subscriber growth is very important to that company, but it wouldn't be as important to a car company like General Motors or Ford, where they have a product that they sell to consumers, and that's the primary way they make money. And lastly, but not least, what do the company's financials look like? Is profit growing? Is revenue growing? Does the company carry a lot of debt? Is there a risk that they'll go bankrupt? Things like that. And again, we'll all be going over this in much more detail in future seminars. So what would you hope to accomplish by doing fundamental analysis? There's a variety of things, and again, it all depends on your investment philosophy. You could be trying to identify some sort of mispricing in a stock, some sort of misinterpretation by the market of what its value actually is. And stocks are really traded on supply and demand in the public market, so often they don't actually reflect their true value based on their fundamentals. So a lot of investors will try and find instances where a stock is overvalued or a stock is undervalued and play that, right? We can also try and identify companies that are well positioned to consistently provide returns to investors over a long period of time, whether that be through dividends or stock price appreciation. Identify companies that will consistently grow for long periods of time. Identify companies that will provide the next big thing. If you use something a lot, it's probably going to be a good investment. Biggest example I can find is Apple. Everyone has a freaking smartphone, right? And if a company, is set to create some sort of revolutionary invention that would change the face of the world, it might be a good investment as well. Think Amazon. Their service really changed the way a lot of people interacted with retailers and the way a lot of people shopped. And last but not least, and this is probably the most important thing, we got to identify companies that people can believe in, and most importantly, that you yourself can believe in. You're putting your money on the line to invest in these companies, so they better be worth investing in. So yeah, that's all I really have for this seminar. Didn't want to really go too long with it. I wanted to keep these relatively short and make them more digestible. I'll be doing these live every Thursday at 7 p.m. EST. So definitely be sure to check those out. If you're not already a member of Trace Trades, definitely check out our website. We offer a lot of services for people interested in the stock market to, get informed and make some money. All right, there's a lot of opportunities out there, and you definitely don't want to miss any one of them. Definitely be sure to like, comment, and subscribe on our YouTube channel. We're definitely trying to build out more of a following here. And yeah, next we'll be going over more of what's going on with the broad market and the economy and how to factor that in when it comes to investing. But that's all I have to say. Thank you guys for watching this video, and I will see you guys all next week. Have a great night.